And there you go. A little bit late, but at least later than usual, that's for sure. I was actually thinking about skipping the whole recording this week. Been of a rough week personally. I didn't feel particularly well. I got a little bit of a flu throughout the week, and then, after being locked in for 4 days, I just wanted to stay out and, you know, being a little bit detached. But then, of course, you know, there are those moments where you remember why you got friends. And so, being a kind of being a little bit provocative here, and it actually once again is spurred me on doing the right thing. So let's have a look at what happened throughout this past week, and we are actually about to start a new one in a few hours, so might be interesting to recap the previous one. So the economic calendar, we can see that we got a few important data points, not only in the US this time around, but surely if you look at what the market did, you know it was mostly US focused. We got jobs opening very early in the week. It was on Tuesday, and you can see that the trend is down. So the cracks in the labor market are now manifesting themselves more and more, and people are really starting to see them and to react to them, as we are going to see a little bit later down the road. Now, then we got Bank of Japan actually being a little bit on the surprise side right here. They hiked rates. They went from 10 basis point or 0.10% up to 0.25%. So decent increase, and you might speculate about it, what it might implies for the GGB market, the Nikkei maybe, and but most importantly, I guess, it's still the relationship in between the yen and the US dollar. Those two currencies to me are still the focus, and we're gonna look at the chart of the USD JPY pair to see how it's going. Well, actually, how it went throughout the week. Then we got, I think, yeah, well, the show of the week was, of course, the FOMC and the press conference, but rates are still untouched. No cuts, no hikes, no nothing. Rates are still where they were. And Powell said, yeah, to me, I watched the full press conference, and it was a lot of the same stuff. I see that and I see that. I understand the concernings. I understand people being worried, but to me, the bottom line was, actually, he repeated that many, many times. He said, if you can read between the lines, he said basically, we wouldn't like to overshoot our policy in terms of fighting inflation, right? We didn't like to overshoot, but if we really have to choose, we do have the means, we do have the tools, or at least we think we have the tools to stimulate the economy if things go south. What we don't have is a way to actually reduce inflation if it gets out of our control. Again, as it was under their control all this time, but that's just the the language that central bankers tend to use. Speaking of central banks, we also had the UK, which finally they decided to cut, I think. Yeah, it was 5.25. It went down a quarter of a percent, so they started to cut as well. And the week actually ended up with a little bit of a fireworks. We got non-farm payroll and unemployment rate. And non-farm payrolls, they were a big miss, as you can see from the charts. Let's try to zoom in on what we are interested in seeing, which is again this downtrend in the data, which is getting softer and softer. But basically, 114K as an actual result and the previous was 179, and it was expected around that level more or less. So it was a big miss, which it adds up to all the down revisions they went through uh, throughout the previous months. And unemployment rate ticking up again, 4.3%. So Powell said we expect the unemployment to stay constant around 4% more or less, and not really going much higher than that. And the last two prints are actually already kind of calling. I can speak English. Calling him a liar, essentially, or at least that's the initial stage of what could be the data starting to really going into the wrong direction. So with this new print, now we can say that it is about time to see the sum rule actually being triggered. Yeah, the magic number has been reached, and yeah, well, overshoot by what? 3 basis points. But the the main focus is that now the rule is triggered, all right? And so everyone presumably are gonna run for the hills. I would advise a little bit of a caution there, but and of course after what happened, you've seen rates. This is a screenshot of the video recorded last week when for September there was an 88% probability, at least as priced in by the futures market, 88% possibility of 0.25% cut. And throughout the week, with the data coming in, it went down to 30. But what increased was the possibility of a 50 basis point cut. And yeah, I mean, if you look at the data now, this is live, so I can just assume this is updated. 80%, 50 basis points cut in September. This is what the CME futures are telling right now. The curves after this week are still inverted, but what about 8 basis point? So it starts to get real at this point. But again, as we discussed, it's not really the first type of a breach that you need to pay attention to, but it might have a tiny fake out in the beginning, as we got when it went inverted, and after it just went down. It went in full inversion and stayed inverted. That's where you need to really pay attention. So the opposite process might be a little bit of a pop and a non-inversion, and it might tick down a little bit, and then it just went up for the full uninversion, which logically it should be expected when rate cuts actually start. So that was pretty much what was important for the week. Now let's have a look at some charts and see how markets really moved. Let's start out with Bitcoin, which is the only market, of course, 24/7 market, which is running right now, and not cool. Not cool at all. We basically failed in here. And if you remember last week, we were discussing about the the timing of the eventual breakout of the highs. And it wasn't really, we established at the end of it, we agreed that it wasn't really a matter of timing per se. It was more of an expected behavior, which after a pickup like this should have been dynamic to the upside. It might chew through it a little bit once it starts to attack the previous resistance, apex, call it as you like. But then you should expect to see it going through, and it did, and it just failed. Now, of course, the area below was tapped into just one, two, kind of three it offered up a last bit of a bounce in here, and then it just went down because at this point the whole area is dry. Uh, I think we are about to revisit the lows, and I guess at that point is game on. I mean that's where you really need to see buyers step in. My first impression looking at it right now is they probably will. I think this area it might offer up at least a tiny bounce, even if it goes down eventually. But I would expect at least another attempt to defend these levels, even if they eventually give in. But the problem is always the same. I mean, if you look at it, these are all high, lower high, low, lower low. Are we in for another lower low? I mean, it's really clear if you look at a weekly time frame like this, right? So not really the strength we were looking at just a few days ago. Actually, it everything changed around this past recent week. Well, it was like that for many other things. To be fair, I mean, let's just say Bitcoin was exhibiting a little bit more of a strength compared to the rest of the market, especially if you consider, equities or other risk-on assets. And but now, I guess with these data, something actually shifted. I'm not saying in the fundamentals, uh, because I've always thought the fundamentals overall they were bad to start out, but it's like that reckoning moment, right? And we're gonna look at it a little bit more of a detail when it gets down to stocks. Okay, let's have a look at gold real quick. Gold, of course, in a risk off scenario, it performed particularly well. Do you remember we were looking at the AQ of the range to hold in order to remain on our bullish bias, and it actually did. And throughout the rest of the week, it was just upside and nothing less. The week actually closed with a what's that? I mean, do you call it a doji, indecision candle? So it's going to be interesting how it opens up next week. It might be it keeps on climbing higher, but I was looking at something which it might be relevant, which is the RSI. If you look at it daily, we are making higher highs, but we are making lower highs on the RSI. So a little bit of a divergence building up, which suggests that, at a point you might see a little bit of a weakness into gold. Will it be next week? Um, I, I wouldn't say so. I mean, it depends on how the rest of the market moves around, but again, I tend to not overcomplicate a lot of stuff around. So up until the point it can maintain its current structure, to me, it's still bullish. Basically, the same point of invalidation to me, it's still relevant. The EQ of the range. We might test a little bit down right here, opening up the week next week, maybe. But I, at the current moment in time, looking at the charts like these, I don't have any particular reason to suspect that gold should really pull back a lot. If not that RSI thing, that divergence which is built up. Okay, let's quickly look. Yeah, quickly. Let's look at oil. Um, it had a nice day right in here. It was what Wednesday. Uh, nice bounce. And again, oil closed down the previous week on a very bearish candle. You got usual behavior, right? The week closed down with a massive bearish candle on Friday. You have a little bit of a continuation Monday and Tuesday, a little bit of a turnaround. But what's important is that it closed the week down. I mean, you got a Thursday reversal, and look at the level it came in, right at the EQ of the range. If you look at gold, right, gold retesting the EQ and marching up, or it just did the opposite, was breaking down, retest the EQ from the downside instead, and it went down. So again, oil is showing a little bit of weakness from a fundamental standpoint, right? When you see oil going down like this, it is just lack of growth and inflation expectations. And when it comes down to inflation expectations, I took a screenshot of the break evens, which are just collapsing down. But that was a hell of a move, I think. So as we've seen in the previous week, oil it might come down a bit more, but be careful because it tends to have these bounces here and there. So even if the final destination might be to the downside, um, just pay attention. And especially in this moment where you read a lot of stuff about the Middle East and Israel, Iran, Lebanon, and whatnot, it's a very complicated situation, and oil might be very subject to erratic and you know out of the blue type of moves with everything going on in the Middle East right now. So pay attention if you are trading oil right now because it could move in unexpected ways depending on the news which are coming out from the Middle East. I wanted to check the BRICS currencies a little bit. It looks like the Chinese yuan had a positive enough week. It rebounded a little bit. Well, sure, it's nothing critical, but still of a rebound. I think somehow this is connected to how the yen rebounded. The yen and the Chinese yuan are pretty much linked together when it comes down to the actual capital flows from the Western hemisphere into what could be Asia, right? Japan is actually a good proxy, a good, let's call it a gate, right? It's a good gate to get that, say, dollar liquidity from the US into China. Oftentimes there are channels and transmission mechanisms which involve the Japanese banks in moving around those flows and that liquidity. So when you see something like this happening, and it's happening at the same time where the yen is actually rebounding, it's a little bit to me that there is a little bit of a correlation there. I think I actually closed down the usual chart with the DXY, the British pound, and the euro. So we are gonna have to manually select them now. Well, it's no big deal. You can just do it like this. DXY, euro, pound, and the yen. Raise the yen. There you go. So the Dixie, with a little bit of a lag, but eventually retested the pocket I was expecting to see retested before actually really testing into the EQ. I was expecting this movement basically 2 weeks ago, if you remember. And I remember last video, it was stalling around here. It didn't really retest deeper into the pocket. But nonetheless, it actually came back down to the EQ of the macro range. The euro had a positive close for this week. Well, at least it's not like it closed the week particularly strong. It's still in this range. But, Friday, of course, was a good day for the euro. The pound, mm, despite they just cut interest rates. So I would have expected to see it following the euro a little bit more closely. They're usually very closely correlated pairs. These two doesn't look like it. At least for now, we're going to see how next week plays out. The yen is actually really rebounding hard. I mean, look at this move. And again, after failing the bounce in here, the the yen just went up. And again, I know went up why the chart is pointing down, but for the sake of simplicity, let's do it this way. Okay, so do we just invert the chart, and now you see the yen going up. Yeah. So I think again the yen going up, it could be it keeps in my mind it keeps on being this unwind of the carry trade. So if you think about it, as I said last week, what happens if you borrowed a lot of yen and then you swap those yens into USDs in order to be able to buy risk on assets in the US, like stocks, for instance. Well, of course, if stocks start to come down, then you sell the stock, you get the USDs back, and now you have to close the other leg of your trade, which is the financing of the trade itself. So you need to swap back those dollars into yen to pay down the the yen the yens that you borrowed, which is why you see the yen rebounding a little bit and at the same time the DXY coming down. Could be a little bit of it. In my mind, if you start to incorporate that in the overall picture, it is. I mean, I'm not buying into the fact that this rebounding of the yen is just tied to the fact that the BOJ hiked another 15 basis points. Also because I already had this conversation quite a lot of time, and last time it was just this week, and my counter argument is always the same. If you think this is just interest rate differential, because now the Japs hiked and Powell basically gave the green light for cuts, so the market is kind of front running this differential playing in. Um, I, I I don't think it is, because at the end of the day, it's not enough to justify something like it. And even if it is, okay, why would you hold JGBs when you can lock in very nice rates on US Treasuries? To me, it doesn't make any sense. So the dynamic of the rates differential in this case, I don't think this is the main factor. All right, it might play a role in it a little bit. Well, maybe, but I wouldn't deem it as the biggest factor at play in this price action right here from a fundamental standpoint. I think the other part of the logic is still the predominant one. Okay, let's have a look at yields, which really plummeting this week. uh, the 30 years 30 years yield went down from I just took the, let's call it the swing high or the last swing high, right? So from the last high to the lows, and I use closes for it. 9.6% essentially. The 10-year yield went down a good 11.5%, and the two went down 12.4, let's call it. Now, I just wanted to measure it this way. It's very intuitive, it's very empirical. It's not rocket science, but just to show and to actually to correct something I said last week. I actually put it in the description of the video. I did it wrong. Basically, I was looking at yields, but I take the measurements and by talking about convexity when it comes down to the underlying bonds and the price movements in them. So I wanted to just to show you that although the short end of the curve is the one which moved the most, if you then look at something very simple like the ETFs, the long duration ETF went up 7%. The mid part of the curve, the mid duration, went up half of it, 3.50, and the short duration went up what, 1%, more or less. So you see that even if the 2 years is the one which went down the most, when it comes down to the assets, so the actual treasuries, the the short end is the one which moved the less. And the opposite case is true at the other end of the curve. although the 30 years is the one which went down the less, you see that long duration bonds are the ones which went up the most. This is basically the convexity thing I was talking about. The price sensitivity is much higher at the long end of the curve for obvious reasons. We discussed about it in previous videos. I think it was the one about Powell being behind the curve. So I guess it was that one, but you know, I also pointed out to a few YouTube videos you might want to watch with the actual math, if you want to look at the math behind it. I'm just limiting myself to explaining the concept, but if you want the math, you're gonna have to look it elsewhere. I'm not gonna explain you the math. Well, mostly because I don't think I would be able to do a very good job at it. All right. Now, let's get down to the nitty gritty. So, equities. Bad week. Bad week, I guess. A little bit of the same patterns we've seen with uh, oil and Bitcoin, essentially. Um, I just charted the Nasdaq because it's the one I follow the most, but it was pretty fascinating behavior. You know, Monday was a dealing range more often than not. Then you got these low put in on Tuesday, a little bit of a turnaround Tuesday, and it went up, hitting back into resistance, previous resistance, some sort of a double bottom in here, but nonetheless, nice level to be retested. And rallying into it while we were getting after the press conference on Wednesday, right? And when we got the labor data on Thursday, it just reversed the hell out of it, and it just went down for new lows. And actually, if you look at Friday, I mean, Friday was ugly. I mean, starting out from Asia, it was bad, and it kept on being bad throughout all the day, and it closed well pretty much around the lows. This is a weak close in my view. So you can observe the same thing if you look at ES, right? It's not charted, but you see it's basically the same. Monday, then a low on Tuesday, turnaround Tuesday, Thursday reversal again. Might want to notice that even on the reversal on Thursday, look at that. These high relative to the previous high of the day for the Asian session, right? This is the overnight period, and the high that ES actually puts in, it's higher than the overnight high. While instead, what we got on NQ, the overnight high is defended. So again, infamous breaking correlation once again. And at the end of it, if you look at them, even on the daily, you still see that they're both going down. NQ is just going down faster and a hell of a lot more. And all it's tied into this relative strength thing that we can see just looking at how highs and lows have been put in. And I've showed many examples of these. I mean, even on the bonds, right? It's kind of the same. You got these breaks in correlation from time to time. It's just something which is, well, first and foremost, it is fascinating to observe, and then it's just something which could be useful to you if you're trading one of the indices. It's always useful to know which one is the relatively stronger or relatively weaker, so to speak. It's not like the small caps did well this week. Huge reversal even on the Russell. You can look at it right here. 2 days down almost 7%, and the last 2 days from the reversal Thursday went down some 3.3% using closes. So equities are just being a little bit dumped, I'd say. And let's have a look at this chart. Throughout the week, I was actually trying to see if I could find price behaviors which were matching up with indicators in order to indicate some sort of a bottom forming. And I was looking at this previous bottom right here, right? Where we are below the moving averages. We got this reaccumulation thingy right here, while the RSI it retakes the exponential and it rallies from it, and the stochastic actually cross to the upside from a very extreme zone, and it gives you the buy signal. It's kind of the same which happened on ES at a point. Same behavior, same read on the indicators. So I was just trying to say if we got something similar, but just looking at the RSI, you can see that it was rejected by the exponential. The stochastics, I guess it's a little bit sloppy, but it's just the nature of the indicator. It's like when we were going up right in here, right? You see that it can't stay in these extreme territory quite a lot if we got a trending market. So that should kind of suggest that we are now having a trending market to the downside. From moving averages standpoint, I mean this is bad. Yes, SPY it lost the 20. It bounced, stalled a little bit on the 50. It tried to retest and regain the 20. It was rejected, and now it broke, and it broke on the 50. And the last bounce was on the 100-day moving average right here. And the Nasdaq, the triple Qs are a little bit worse than that. Uh, they have already broken the 20. Kind of tried to retested it, not even retested it. It broke the 50, so the retest is on the 50 this time around. And we were already bouncing off from the 100-day moving average, and now we broke through three very important moving averages in my view. We are now below the 100 days, so I guess if this thing wants to continue down, should look around the 200 days moving average at this point. I mean that seems to be the path ahead, but oh, we're gonna look at it in a minute. But what I wanted to say as well, it's look, don't overreact, right? Whether you are day trading this market or whether you are actually running a portfolio, I think it's kind of pointless to run for the hills now. You're gonna see people starting to talk about buying puts, buying protection. I mean that trend is gone. These were the times where you should have bought protection when puts were so cheap because nobody felt the need of hedging himself. Uh, it's like having an insurance. When do you sign up an insurance contract? When things are going good. You you don't buy, let's say, an insurance against your house being set on fire when the house is already on fire. You should have done it before. Okay, that's the point. Also, because if you look at how, let's say, puts on these indices were priced in just 1 week ago, 2 weeks ago, and how they are priced in now, of course, it's pointless to buy puts on it right now because you're gonna pay a much higher premium, and basically the move you were expecting to profit from that edges is already done. And even if it keeps on going down, the risk reward it's a little bit less skewed in your favor. So you're gonna pay more, which just just starting out with that, it erodes a little bit of your payoff. And if you look at prior behaviors, one thing which is very likely, since this is, no matter how bad it might be, no matter how the media are now starting to talk about the stock market crashing, this is not a crash. This is still correction territory because if you look at SPY is what 5.5% down. The Qs are what 10% down. It's not a crash. I mean, it's a correction, and it's going down particularly orderly. So it's not like this is panic selling and you've lost 5-10% in a day. Um, so expect a little bit of a bounce. And then if you want to de-risk or to rebalance your portfolio on that bounce, that will give you the opportunity. Or even if you want to buy put at that point where the market it rebounds a little bit, that's if you think it's gonna keep on going down after it, that's the moment where you want to buy protection or playing to the downside. But, but my advice would be don't panic out on Monday morning and start to buy puts like there was no tomorrow, or to sell everything you got in your portfolio. At this point, it's a little bit too late for that. So if you didn't, the risk before, guess now you have to now you really have to live with it and see how it goes. But just try to be calm as much as you can, and whatever you do, make it as small changes here and there. Don't turn around your own investment strategy just because something is currently going bad. Okay, and bear in mind this is still an election year. Um, I was looking at it, and there are still 500 billions of dollars from the Inflation Reduction Act, which are not being they have not been spent yet. So there is still a little bit of liquidity which is available for the economy at the current moment in time. And all it takes, really, if you combine the technicals and the price behavior, all it takes to have a pretty decent bounce from here is the ISM services index coming out and exceeding expectation on Monday. Because when you think of the US economy, which is 70% consumption, I know people are often looking at the industrial sector and saying it is a leading indicator because where the industrial goes, services are going to follow with a lag. But just bear in mind these things they don't happen over time overnight. So I guess it's going to be interesting to see how the data will be and how the market responds. Because now what you want to see, what you want to verify is that the market is unable to respond well to good news. So let's say we got the ISM services on Monday and the data is good and the market it doesn't bounce and it keeps on plunging. Then the market is reacting negatively to positive news, and that's a good tell. It's very valuable information you should pay attention to. So again, just give it a little bit of a time, be patient a little bit. I mean, at the end of the day, if you didn't sell before, right, and the market is down from the highs, what, 5%, essentially almost six, but from 6 and 5, would it be so bad if you lose another one or two at this point? I mean, or I would rather risk it at this point instead of making very emotional decisions, But everyone is different at the end, so I'm not actually saying that people should do what I would do, but at least that's what I would do, and that's the thinking I would have. All right. Now this chart it was I posted it on Discord, and it was looking at the VIX and the S&P. So you can see that basically these previous lows for the S&P, they were put in in conjunction with these spikes on volatility on the VIX. Okay, and every spike in volatility was following this trend line, which is downsloped, of course, so volatility was a little bit suppressed. So I was saying, you know what, it might be, if you want to see this one as a low, you would expect volatility to be suppressed once again. And instead, volatility broke out of this trend line now, kind of like it broke out of resistance, if you want to call it like that. And at the same time, the S&P broke down from this trend line. I'm not really a huge fan of trend lines, but it's just another visual representation of market structure, if you want to take it like that. So Is it the Holy Grail? No. Actually, I think we might have a little bit of a pullback in volatility, which might be a little bit of a bounce on the index, and then we'll see. We play the game of what happens next. One step after the other. It was just a good signal to have a changing behavior in here, and and let's look at how the next week it's going to play out. Um, I think yeah, I finished up with the charts, so there's really nothing else I wanted to discuss. Um, you know, keep on following this logic. I think, the landscape right now, it can really change on a dime, right? It's just a little bit of a piece of news right here, a little bit of a piece of news right there, and the market can respond particularly violently one way or the other. I think this is the time to be nimble. This is the time to be a little bit less of a risk taker for obvious reasons, right? Congratulations, Captain Obvious. How could we do it if you didn't tell us, right? But no, seriously, even with your day trading activity, because I've seen people saying, oh, well, you know what, it's the easiest game ever. We were buying the dip before, now we're gonna short the rallies. It's easy to say in theory, but then I wanna see you doing it in practice. Because if you trade these indices, you would realize that even intraday, they are capable of huge rallies in your face. So if you are staying there, trying to short every minimal type of a bounce they have, you can have another thing coming. And it might be short lived. It might last for what? 30 minutes, an hour top, and then everything crashes back down. But the problem is, if you spend an hour of your day or of your session trying to short a market which is constantly coming up, you're gonna do your asses for the day. So this is why I'm saying be a little bit more selective these days, even in your with your intraday type of activity. That would be my take on it. Okay, it's sometimes it's better to lose a major swing and not participate into it instead of trying to get in 10 times and being stopped out 10 times. I mean, does it matter if you're going to get it right at the 11th if you lost 10% of your account trying to short it the previous 10 times? To me, it doesn't make a lot of sense. So, just pay attention to it. Now, the let's close in with this. I think what would be wise to do right now is trying to be a little bit isolated from, you know, media and news stream, because I think it's going to be a little bit of a mess, and I think it might be much better for everyone if you just stick to the charts. Um, it looks like, now we have that turnaround. You remember we were discussing last week about what's the most important thing, price action or sentiment? And I would say to me it's price action because sentiment can shift if price action shifts first. Now it looks like the market is waking up to this thing about wait, the price is really behaving in a way which is not it's not bullish anymore. And the sentiment shift, especially in the initial stages, can be very powerful. So you're probably going to read a hell of a lot of end of the world type of news now. While up until less than 1 month ago, everyone was talking about how the economy is resilient, the labor market is still okayish, inflation is coming down to target, it's going to be a soft landing, and it looks like now everyone is panicking and saying, oh, the Fed is behind the curve. But wait, do you just realize it right now? I mean, it's like quoting a little bit of an influencer I follow pretty constantly and regularly. It's like quoting George Gammon, right? It's like saying Joe Biden was completely sharp and intelligent. It was a little bit of a fox, right? And then the debate comes in, and you wake up and you realize, wait a minute, this man doesn't know, it doesn't even know where he is. It doesn't even know what he's talking about. He's got dementia. Wait, but up until previous week, it was sharp as a tack. Now he's got dementia. So there is this type of a Willy Coyote moment. The problem with that is that we tend to think in a way as things should happen overnight, but instead they just don't. It doesn't happen in macro, and it doesn't even happen when it comes down to financial markets. So the actual charts that we look at every single day, they're going to take their time, especially because you need to consider that what is going on right now. Again, I'm going to say it again because I think it's important to note that it's not a crash. This is not the 2020 crash yet. This is not the Rona dump. I think at this stage, right now, I think you shouldn't expect the market to go down, let's say, 15% in a week, right? It might keep on going down, but up until the point it goes down like this, right? It goes down, it draws back, goes down, draws back, goes down, draws back. You're gonna have a hell of a lot of time to make the adjustments you need to make in your portfolio, to the risk, to take short entries to add your portfolio if you don't want to load stuff that you want for the long term, to buy puts when the market is coming at levels where those puts make sense to be bought from a pricing standpoint. So just again, just your most valuable asset right now is calm. Being able to stay calm and remaining rational while the rest of the world is losing it is pretty valuable. And whether you like it or not, you're gonna learn it to some degree if you wanna stay in this game. And final thing, stop. Just stop predicting. All right, stop predicting what the next black swan is going to be. It's going to be a war in the Middle East, an escalation in the Middle East. It's going to be another bunch of banks coming down, and the Fed needs to step in and re-engaging in QE and whatnot. It's going to be whatever. We don't know. There are many things which could go wrong, but just because you can think of 100, if you can think it, just be humble. If you can think it, the market already thought of it, and it knows in advance. So it is already priced in. What can really shock market is always an exogenous event, and nobody is really paying attention to it. I know you might say, yeah, but there are, maybe two, three, four guys in the entire world which are seeing it coming and they're gonna make a hell of a lot of money. Okay, if you want to be one of the three, four, five guys which are gonna see it, fine. It's all up to you. Um, just remind even Michael Burry was almost blown up for shorting the real estate market with two 2 years anticipation, basically. So even being early, it's at the end of the day, it's actually being wrong if you get fucked before what you think it's gonna be unfolded. It's gonna unfold itself. So take your time. Don't be irrational. Don't be emotional, and try to make little adjustments. All right. The market is smarter than you. You need to realize that the market will always know better, will always know first. So you don't have to time the market, you don't have to anticipate the market, and you don't have to actually outperform the market. Forget that bullshit. It's nonsense. And it goes for your investing portfolio and it goes for your trading account. So again, keep your head on your shoulders. That's the main piece of advice I I would feel comfortable giving out for this week. I guess this is gonna make up for it. I guess this is all. Hmm. I was just thinking back of something I just said. I think I just found a nice thumbnail for the video, right? You're gonna see it. So again, thank you again, Pena, for reminding me that I need to stay consistent no matter what. And guess I'll see you all next week at this point. And as usual, although the weekend is almost over at this point, but if not for the weekend, which is already gone, for the rest of the week, which is coming up. Be nice and be cool. Nils out.